Hej allihopa och välkommen till Pengaflödet-podcasten. Mitt namn är Emily.
Och mitt namn är Nanna.
Vi håller på med fastighetsinvesteringar i Storbritannien. Och den här podden kommer handla om just detta och vi kommer varje vecka ta upp relevanta ämnen och intervjua personer som vi finner inspirerande.
Hej! Välkommen till Pengaflödet-podcast. Today we have Kate. How is it, Kate?
Hey, how's it going?
I'm fine. I'm here in Sweden, sunny Sweden. I don't know what's the weather where you are.
Well, you picked a good day to call me because I can actually say it's sunny here in the UK too.
I heard you were out with the horses before. How many horses do you have?
I've got 3 horses. They're about 6 miles from me, but it's really good because obviously we've all been in lockdown in the UK, and it's good to go and spend some time out in the fresh air with them.
Yeah, I can just imagine that. So today, I thought you should tell us about your background and what you do.
Perfect. Okay. So my background, obviously, I'm a mortgage advisor, but I also deal with expat clients, foreign national clients. I got into the mortgage industry in 2015 after a career in fitness and the police. The reason I went into the finance industry, specifically mortgage finance, is because my mum and brother have done it their whole lives. And I thought it was about time that I joined the family. So I began working for a company called Touchstone Commercial. And basically they are a commercial loan specialist. And that's where I began, did all my exams, began working with them. They did regulated mortgages, buy-to-lets, second charges, bridging, literally all the finance you can think of, they did it. So I had to learn really quickly. And I stayed with them for a few years. I mostly did buy-to-let and residential mortgages for people in the UK. And I also dealt with expats quite a lot. So ex-UK residents that had moved abroad. And then that opened me up into dealing with foreign national investors who are now coming to the UK quite a lot. And then I ended up going to work for a company called B2B Finance, which I believe you're aware of, Nana.
Yes.
And again, they are advertised a lot on the internet. They were a big company. And again, we got lots of leads given to us. But the thing I didn't like about them is I wasn't getting a chance to build a relationship with my clients, which was important to me. I felt like we had too many leads coming in, and we didn't have enough time to actually get to know the client. So in the end, I set up my own company, which is called Gaia Financial. And I've been running this company since 2016-17 now. And basically, we cover a bit of everything. I've got a few advisors working for me. We cover everything in the UK: residential, buy-to-let, second charges, bridging finance, commercial loans. And then me specifically, I work with my foreign investors, and I deal a lot with equity release cases as well, which I don't know if you know much about that, but it's kind of lending for people after the age of 55 in the UK. And that's my background.
Basically, you started to become a broker because of your brother and your mom, right?
Yeah, my mum worked for, I don't know if you guys will remember, this big company called the Lehman Brothers. They were an American company.
Yeah.
Back in 2008 when we had the crash. Unfortunately, it was due to the Lehman Brothers and their business going down. And my mum was part of that company. And then my brother also deals with just UK residential mortgages. And I just kind of thought, I wanted a career change. I wanted to do something different. I wanted to have my own company, so I had my own freedom instead of working for people. I found when I worked for these other companies, they're so quick to charge clients big fees. And I don't think it's about doing that. You have to charge fees, of course, but it's about building a long-term relationship with clients. And that's why I came into the mortgage industry. It's just something that really appealed to me.
Okay. So what kind of license or certificate should a broker have?
So that's a good question. Now, with buy-to-lets, that you have never lived in. So if you own a buy-to-let in the UK and you have never lived in the property, it's classed as non-regulated. If you buy a commercial property in the UK, it's classed as non-regulated. And at the moment in the UK, it's a bit weird with legislation. So after 2008, there was a legislation that came in the UK that said that anybody that did regulated mortgages, and regulated again is a property that you own and you live in for more than 40% of the time, you have to do up to level 3 in certificate mortgage advice and practice. So you have to do your level 1, your level 2, your level 3. Your level 1 is all the basics about the financial service industry. And then level 2 comes into mortgages, and level 3 again is mortgages. So the interesting question to what you were saying is, a lot of people who get mortgages for foreign investors for buy-to-lets and commercial, they don't have any qualifications. It's literally what they've learnt on the job. But I myself, because I started in a regulated background, I had to go and do all of the qualifications. So the qualifications to look out for, for myself, I have what's called CMAP. And again, the letters are after an advisor's name. And I also have CRA, which is the Certificate in Equity Release qualification, which is also a level 3.
So basically, you, as an investor, a foreign investor, or you should look after these two type of licenses, or ask for them if they're.
It's really hard because I think it's obviously good to have qualifications, but at the same time, there are a few companies out there that have dealt a lot with commercial and buy-to-let lenders and clients that haven't got these qualifications. But it's really hard. It's like with anything, isn't it? You can have qualified people that are not very good, but then you can have not qualified people that are very good. So I think it's always good to have some kind of a basic qualification in the background, but it really depends. It really depends on the brokers. You'll get a feel for them straight away, like you did.
Yeah, like I did. So, do you own properties yourself, or is it just you're just doing the broker bit?
Yeah, no. I own properties. They're all in the UK. So I have 3 buy-to-let properties and I have 1 residential property. At the moment, I have them all owned in my own name. But going forwards, because of the new taxation changes, I'm going to be setting up a limited company. So any properties that I buy later on will all be through that limited company.
Okay. That's a good point as well, to have a broker that purchasing properties who knows what yourself going through. So that's a good point. So what kind of mortgage products can an international investor get?
Again, so you can kind of do anything. It depends on your situation, what you're looking to do, but you can definitely do buy-to-let products. I find it easier with dealing with clients when they're looking to do buy-to-lets in a limited company, because we can obviously set the UK company up in the UK, get the relevant SIC codes on, which is the registration codes for that company, which then the company will have UK bank accounts, and in that limited company, then you can purchase buy-to-lets, commercial properties. And again, if you're coming to the UK and you were looking to come to the UK and live here and stay here, then potentially would then be able to buy residential properties.
Okay. So have lending changed now after Corona? Is it harder for us international investors to get it if you compare to before Corona?
I have to say, I think it's harder for everyone right now, simply because a lot of the lenders have been a bit overcautious. So we've got lenders like Bluestone, Precise. They're completely pulled from the market for a while. A lot of lenders, because they didn't know what was going to happen with house prices. So if, for instance, in the UK, you could buy a property with 80% loan to value, the lenders are pulling those products because obviously if house prices crash, that's going to put a stress on the property and potentially make the property go into negative equity. So I found in the first 4 weeks, a lot of mortgage companies were either taking their products away completely for a while and putting them on pause, or the big high street banks were saying, look, we're not doing 95, 90, 85% loan to value lending anymore. It's going to be like anything from 60 to 70% and under. So there's definitely changes. It's definitely not as easy at the moment. But that being said, by the day at the moment, I'm seeing the lenders slowly coming back. Precise came back today. They've gone back up to 70% loan to value. Octopus, who's a really good lender for you guys when you're abroad, they deal a lot with foreign investors. They haven't come back yet, but they are one that would be good for you when they do come back.
Okay. And what type of LTV could we see before Corona, and what type of LTV can we see now for us international investor?
So again, you could potentially get up to 75% as long as everything else stacks up previously. Octopus, again, they would go up to 75%. But if you're really wanting to open yourself up to most lenders, 65% would kind of get you better rates.
Yeah. Okay. So 65, that's fair. So could you explain to us the difference between normal mortgage and Sharia mortgage? Because this is something that's been very people have spoken about it in our community here in Sweden who invest in UK. So I thought it's better to get it clear from the broker herself.
Of course. So basically, a normal mortgage is for everybody. How it's done is you purchase a property, you borrow a loan from a bank, the bank gives you an interest rate, and you then end up paying the lender back the interest with capital or not capital. So for instance, if it's an interest only mortgage, you will always say you borrow 200,000 from the lender and it's on a normal mortgage. Then after a while you will keep paying the mortgage, and after the term has finished, the 5-year fix, the 2-year fix, you will still owe the 200,000. The property's yours, but then you can switch over to a different lender. Also, the solicitor and legal work isn't as tricky. So basically a Sharia mortgage. Now, a Sharia mortgage is an Islamic mortgage, and it's compliant with Sharia law. So obviously Muslims have different belief systems to us, and these mortgage differs from traditional loans because they don't involve paying the interest, because under Sharia law, it's forbidden to pay interest. So it's kind of really weird because to me, it's kind of the same thing. But what is happening actually is you're purchasing the property, but the lender owns the property, and you will need to give at least 20% deposit for the property. And then what happens? You agree to pay back the purchase price again through monthly fixed installments. So it's slightly different because it's not worked off of the base rate and the lender's rates. It's done through a purchase price fixed installment. And again, you basically pay off, you pay interest to the lender, but it's kind of, instead of it known as interest, it's known as rent. Now, to me, it's really weird because it kind of is the same, but it isn't the same because the legal work is a lot more expensive. It takes a lot more time. And in theory, the property isn't yours. You're renting it from the lender. The other thing with Sharia mortgages is there's lenders like Gatehouse, and the reason people go to them is because they're rate driven. And now because lenders like Octopus and Castle Trust, because you're buying the property and they are giving you a percentage rate on the risk of you being a foreign investor, the interest rates look higher, but it will go through quicker and the solicitor works quicker. Sharia mortgages, because basically they're giving you an interest rate, which is actually just a rent payment, and then you've got all the legal side. I've just, I told you this before, I had a property with a client with Gatehouse, and it's taken just shy of a year to complete. Fair enough, there were other issues involved, but I've only dealt with Gatehouse 5 times, and all of them took well over 6 months.
Wow. A lot can happen in the property world in 6 months.
Yeah, it's just quite a complicated process, and they ask a lot of questions. They literally want war and peace from you, whereas clients like Octopus, Castle Trust, Interbay, whilst they want to make sure you're good for the mortgage, that it's just a different process.
Is there any pros beside the interest rate?
Yeah, no, that is the only pro that I have literally figured out, is the fact that you will get a lower interest rate. And unfortunately, some clients, I mean, this client of mine that I put with them, he was so rate driven. He did not want interest rates of 5-6%. But unfortunately it's done in the meantime is he's probably spent that money on the rate for the solicitors, the legal work, and the extra valuation works that he's had to have done to comply with this mortgage.
Yeah. So can you use a Sharia-owned house as security when you don't own it?
So again, in theory, a Sharia mortgage, the lender actually owns the property, and you rent it from them until the mortgage is completely repaid.
So the transfer of deed, you won't have it when you put that with them, right? They
would have the deed.
Yeah. So basically.
But then saying that with normal mortgages as well, the lender normally holds the deed until you pay back the loan. But with Sharia mortgages, as I said, you rent the property from them until you've repaid the loan.
The house that you have with them, can you use it as
bridging finance?
Yeah.
Do you know what? Potentially you could, but I have to say I've never actually tried to do a bridge behind a Sharia loan. So I actually would hold my hands up there and say I actually don't know the answer to that question.
Okay.
I've never ever had to do a bridge behind a Sharia mortgage, thankfully.
Yeah. So should international investors take a private mortgage or a company mortgage, and what is the pros and cons?
Okay, so with taking a company mortgage, obviously in the UK, if it's done for a company, potentially it's going to cost a little bit more early on, because you're going to have more accountancy fees and everything. But potentially it opens you up to more lenders because it's done through a limited company as opposed to sole name. It will open you up to more lenders. It will potentially have slightly higher rates if it's in a limited company, because they class you as professionals. It's done as an investment, so the interest rates and the lender fees can be higher. You're looking at lender fees. Let's say you borrow 200,000. The lender fees can be anything from 1.5 to 2% of the loan. If you buy in your sole name, the interest rates can be lower, but there are less lenders that lend to foreign investors in that way, because obviously you don't have to. With a company set up in the UK, you then have a footprint in the UK. You have UK bank accounts set up, and it just makes the process easier. And again, for taxation reasons, if you have it in your sole name in the UK, you cannot offset the mortgage against the interest rate. Sorry, you cannot offset the interest of the mortgage off of the profit that you make from the property. That was abolished in January 2020. It finished. So basically, if you own a buy-to-let property, if your rent is £10,000 a year and you're paying £5,000 a year in fees for your mortgage, you would still then have to pay the interest on your 10% if that was over the bracket. Whereas in a limited company, the interest of the mortgage is knocked off of the profit and you only pay tax on the remaining.
Okay, fair enough. So could you explain the difference between mortgages products that is available for international investors: tracker, repayment, interest only, etc. There's so many out there.
Okay, so a lot of investors in the UK tend to go for a fixed product now, and a lot of buy-to-let lenders tend to only offer fixed products. The reason for that is that the bank knows that they've got you for a certain period of time, and if you tend to leave the product, you will have to pay an early repayment charge to leave them. So the charges could be, if you took a 2-year fix, the charges could be anything from 2 to 3% in year one. If you took a 5-year fix, they could be anything from 5 to 6% in year one if you decided to get rid of the mortgage. A lot of people used to do trackers because they didn't want to fix in and because they wanted to leave the product after a year. Unfortunately, the lenders have got their heads around that now. So if there are any trackers available, which are very, very rare, I don't even know a tracker rate product at the moment for investors. But if there was a tracker rate product offered, the lender would also then have ERCs on that product, which isn't always a good thing, because if you're tracking a rate, for instance, the base rate, and suddenly the rate starts to increase, to come out of that product, you're going to then get charged a fee. There's other products out there, and again, there's standard variable rate products. Again, most of the time now, these also have early repayment charges if you want to come out of them early. So it's a tough one. Personally, most of my clients, 90% of my clients now always go for a fixed product.
So what fees do we need to consider?
So the fees you guys would need to consider is the lender. Obviously, the lender fee cannot always normally be added to the loan. So again, that can be up to 2%. I haven't known lenders charge more than 2%. That tends to be the max. Advisor fee, I always charge if it's a brand new property and it's the first time that we've done work together. It's a flat rate of $999. What I tend to do is I charge $195 on application, and then once it gets to £195, that's just to cover the work that I've done, and then the rest I would take on offer. So once the mortgage is offered and we know it's all going to happen, I would take the rest of the fee at that stage. Other fees you would need to consider are valuation fees. So again, in the UK, the lenders tend to value properties on their worth. So for instance, if the house is worth 100,000, the valuation might be £300. If it's 200,000, it might go up to £500, and so on. So it's staircases. So you will have a valuation fee to pay. I always say to all of my foreign investor clients, don't accept them to do the valuation until the application has been accepted. Because once they value the property, which can speed things up, if you say to them, look, I want to pay for the valuation day one, and I want you to do it to speed this up, what you have to be aware of is if that valuation gets done and you spend £600, £700, £800, if the lender then decides they don't like your case, you will lose that money instantly. So wow. I would always advise, don't have the valuation done until the lender is happy with your case, and then that's all that's outstanding. And then the other fees is just making sure you get a good solicitor. I've had clients before now that have gone to solicitors, they've started the process, then they've realised the client's abroad and they don't deal with clients that are abroad. There's some lenders that don't like some solicitors, so you have to make sure that the solicitors fit with the lenders panel. Again, every time you go to a lender, if you've got a specific solicitor you use, always say to your broker, this is my solicitor. Can you just check with the lender that they're happy for us to use them? And again, if you guys want to cut costs and not pay double fees, when you're purchasing property in the UK, always try and get solicitors that will do dual representation. And that basically means that the lender, they will do the work for the lender and they will do the work for the client. So you only pay one fee. Whereas sometimes if the lender says, no, we don't like your solicitors, we're going to use our own as well, you'll end up having to pay 2 solicitor costs.
Okay, that's a great golden nugget there. So usually, how long does applying to get a mortgage?
Okay, so again, in the UK, it's fun. I have my clients abroad in Dubai, and they like to say it takes 2 weeks, 3 weeks, and it's like quite shocking to admit here in the UK. The quickest I've ever seen a foreign investor mortgage go through is probably just short of 3 months. The things that slow it down in the UK is the legal process as well as the lending. A lot of people don't start paying for their legals as solicitors until the mortgage is agreed. Again, that's good if you want to make sure that the property is going to go through, but the downside is it does slow things down. So if a foreign mortgage takes 3, maybe 4 weeks to be agreed with the lender, and then the solicitors is going to take 4 to 6 weeks to start doing their work. Again, in the UK, if you want a property purchase to go through quicker, always ask the estate agents or the people you're purchasing the property from, is there a chain? Because again, if there's a chain, this massively slows things down because everybody needs to agree to complete at the same time.
Yeah, you're dropping some golden nuggets here.
Golden nuggets.
So what should we as international investors have ready when applying or contacting a broker such as you?
Okay, so always when you first start speaking to an advisor, I would always have your income to hand, how much deposit that you've got to hand, what kind of properties you're looking at, what kind of experience you've got. Also let your advisor know that obviously, are you rate driven? If you are you willing to take a lender that's a bit slower, or are you interested in basically building up your property portfolio quicker and you want more efficient lenders? All of these things are going to help. Also, I would start to know if you've got your solicitors handy, what kind of properties you want, what part of the UK that you want them in. A lot of lenders, for instance, they just like properties in the big cities, so like London, Manchester. They don't like properties that are on the outskirts. Again, in the UK, I don't know how it works in Sweden, but in the UK, there's different types of properties. So you could buy a house, and the house is a freehold property. So that means that if you purchase that property, it's 100% yours. You can do whatever you want to it, and that makes life a lot easier with the lenders. If you purchase flats in the UK, there's 2 different types of flats. You have a freehold flat and you have a leasehold flat. And there is also common hold, but they're not that common, so I won't go into them. But basically, if you're looking for a flat, try and make sure it's it's leasehold, and the lease is over 90 years. And just to explain what that means, it's basically a house in the UK or a block of flats that's been built. And what the freeholder of the building does when he builds that property is he creates leases and splits the titles of each individual unit. And what that does is it has a separate company that then manages the building to make sure that the upkeep of the building is kept in good order. Now, if you buy a freehold flat and there's 3 flats in the building, there is actually no company in place to make sure that if the roof has a problem and leaks, that it's written in an agreement that all 3 flats will have to fix it. So if it's a freehold flat, the bottom floor flat might say, I'm not getting involved, it's not affecting me, so you can pay for it. So the lenders don't like this because they class it as a risk to their security, because there's a chance that the upkeep of the property isn't gonna get looked after. The downside to having flats with leasehold, whilst the property is going to get maintained and looked after, in the UK, the leasehold managing agent companies can take the mick a little bit with costs. I've got 2 flats in the UK, and they're leasehold flats. And what happens is the managing agent say to me that I have to pay a fee monthly for the upkeep of the property, and that fee can be anything from £100 to £500 a month on top of your mortgage. Oh. So again, when you're starting to speak to people about properties, I've kind of diversed off a bit here, but it's just important to mention this. Also, make sure that you know all the additional costs that are coming with that property.
Not a golden nugget, but I have one question that I thought about. We have been told that it's very hard to get lending in Scotland. Is that true?
Yeah, again, there are lenders coming back into the market that will do it, but it's basically due to house prices in Scotland. The lenders don't really class it. A lender will always lend because they want to make money. And properties in Scotland aren't known for being I guess money making to the lender, and it's a bit more risky. That being said, there are lenders that will lend in Scotland. It just depends on the area. So if it's something that you're interested in purchasing in Scotland, which is a beautiful place, just also make sure that the advisor knows, because it will limit who you can go to.
Yeah, that's what I've been told, that it's not so many lenders there operating.
Yeah, it's just slightly different. There are lenders, but it limits you. And I think when you're trying to buy in the UK to begin with, it's really important to give yourself access to as many lenders as you can.
Yeah. So does it really benefit us if we have been operating 2 years in the UK as an international investor?
Yeah, definitely. And the reason for that simply is that the lender will see you as less risk. If you've been operating and you've got 2 years bank accounts and you've got a limited company and it's filed its taxes, you're going to look like a reliable company to the lender. Whereas if you're a brand new company setting up for the first time, you just need to make sure that the lender's going to see you as a bigger risk. So therefore your rates might be slightly increased because of that. And just whilst we're on that subject, a lot of people just think they can set up any limited company and buy property in it. Make sure that you do your research and you get an accountant that knows about accountancy for property, because there are specific SIC codes that the lenders like. And again, I can send you them later, Nan. I haven't got them in front of me right now, but there's 3 different types of SIC codes, and the SIC code is basically the code of the limited company to explain what that company is going to be used for. So we don't want to be buying property in a limited company that's set up to run a kebab shop, for instance.
Yeah, I will appreciate that, and I will share it to the group so they know while they're trying to get a mortgage on their houses.
If you Google SIC codes for limited companies on Google, UK SIC codes for purchasing property in limited company, it's quite easy to find, and the lenders will publish those quite easily for you.
Could you explain bridging for the listeners? And is bridging dangerous? And if it is, then why?
Okay, so bridging's a fascinating product, and it's a lot easier to get, and it can complete a lot quicker. Now, if you wanted to buy a property at auction in the UK, you have to have that property complete. The finance needs to be complete in 30 days. So a normal mortgage would not be quick enough, and that's why people tend to do bridging mortgages. Also in the UK, you can only purchase properties, especially buy-to-lets and residential, that are habitable. So if you found this really good deal in London, and you saw this lovely big, 5-bedroom detached house, but it had no roof and the kitchen was unusable, but you knew that you could make really good money on that, you would never be able to purchase that with a buy-to-let or residential mortgage. So it would have to be done through bridging. Now, the risk with bridging is, one, it's expensive, and the interest rolls up. So, for instance, the interest might be at 1%, maybe 1.5%, which doesn't sound a lot, but what that does is it rolls up each month. So if you're borrowing, let's say £200,000 on a bridge, that interest will roll up monthly, and it will keep rolling up. So for instance, I was going to do a property. Let me give you an example. I was going to do bridging finance on a property for a couple of clients. They wanted to buy an equestrian property and they hadn't sold their house, and they were going to lose this property and they really wanted it. And we were talking about bridging finance. Thankfully, I talked them out of it. But just to explain what the costs look like, the fees up front can be really, really high. So you're looking at sometimes fees of up to £10,000. That does get added to the loan. And this mortgage that they wanted to borrow, I believe it was 450,000, and the interest alone rolled up on that would have been £60,000 within 12 months.
Wow.
So bridging is very good if it's used for the right reasons, and if you're going to make serious money. So if you know that you're going to buy a property for 300,000 and you could potentially value it up to 2 million if you had it for 6 months, great. Now, again, the reason bridging is dangerous is because you have it for a set term. So you could say, Kate, I want a bridging finance for 6 months. And I'd say, okay, what's your plan to get out of that bridge? And you could say, I'm going to have the property, I'm going to refurbish it from head to toe, and then I want to put it on a buy-to-let mortgage. Now, that's kind of a safer option. What you need to make sure first is that you have an advisor that can definitely get you the buy-to-let mortgage, because the last thing you want to do is be in a bridge at 4 months and suddenly you can't get a buy-to-let mortgage. Because what happens at the end of that 6 months is, if there's enough equity, you could potentially then roll that onto another bridge. But if it's not, the lender will basically repossess the property and sell it, and you will lose everything.
Wow. Like...
Yeah. So bridging is very good. I've used bridging a few times. It's really, really good for commercial. It's really good for people that know what they're doing and if they've got their finance set up. But if you said to me, Kate, I want to buy a property and I'm going to flip it. So I'm going to get a property, I'm going to refurbish it, and then I want to sell it. To me, that's a bit more risky because there's no guarantee that we're going to sell that property in time. So so basically a bridge can be done on anything. It can be done on the new property, or some people, for instance, let's say a guy owns land in the UK and a property, and they've split the title and they want to build a new house. Some people will then bridge their own house, use that as security, and then what they will then do is use the money, build the new house, and then remortgage the new house and refinance back the money for the bridge. So there's lots of different things you can do with bridging. And you have to be very careful because there's a lot of brokers in the UK, going back to your discussion, commercial lending and buy-to-let lending isn't regulated. So you don't always have people, again, with qualifications and again with morals. And I've known a couple of people sort bridging finance out for clients, and they don't care about how the client's going to get out of it. They warn the client that it's their responsibility to make sure they can, but they just give them the bridge, use their vulnerabilities, and then they don't help them any further. And then it's the client then has to go to somebody else to help them. And of course, if they haven't done that in the meantime, then there's not always a guarantee that there's an option for them to come out of that bridge. So what I would always say is bridging, again, is brilliant, but you need to make sure, one, you've got someone that's going to get you the bridge, and two, you've definitely got an exit that you're comfortable with and that you know the risks, and that could be that you could lose the property.
Could you explain what is cross bridging?
How can I explain it? It's like a cross collateral loan. So the lenders basically finance 2, 3, 4 or so properties. So that's kind of cross bridging. So if you can't raise enough on one property, and again, I can give you this example. I had 2 clients, again, they were living in an equestrian property. They really wanted this other property. It was like a 12-bedroom detached house with about 30 acres of land. It was stunning, absolutely stunning. But they couldn't get a seller for their property. And what they were going to do before this all happened is we were going to do a cross bridge. So basically we were going to do a bridge on their house, but because they needed to find money to purchase the new house, their current house didn't have enough equity in it. So what we ended up doing is bridging the other property as well. Well, what we were going to do is bridge the new property. So the lender will take 2 properties as security.
Okay. Yeah, that's a great explanation. So what is first charge and second charge?
Okay, so really simple. First charge in the UK is basically known as a first mortgage on the house. So let's say Mr. and Mrs. Jones want to buy a property in London, whether that's a buy-to-let mortgage, Sharia mortgage, or a residential mortgage. It's known as a first charge, and it basically means that there is only one charge on that property, and it's a first charge, and that lender has that first charge. What a second charge is, and again, they're really good loans if you need them. A second charge is basically a second mortgage on that same property. There's a lot of reasons why people do this, and I'll give you an example for what one reason might be. If you buy a property, so let's say you've bought a property in London, it's valued at 400,000, and you want to put 200,000 down as a deposit, and you know you're going to spend about £60,000 on that property, refurbish it, and it's going to take the value up to 600,000. After that, you've to get that mortgage, you might have had to tie yourself into a 5-year fix, or possibly even a 2-year fix. Now, after you've done that work, you might think, actually, I've spent too much money. I've gone into my reserves. I'm now tied into the property with a 5-year fix. If I leave that mortgage, I'm going to have to pay a high fee, but I need to raise more money. What do I do? This is when a second charge will come in. So basically, you go to a second charge lender, and they basically go to your first charge lender and they say, look, we know that Mr. Jones has got a £200,000 mortgage with you, but we're going to lend them an additional £100. Are you happy with that? Now, the first charge lender, 9 times out of 10, will say, yes, that's absolutely fine. And then what will happen is the second charge lender will sit behind the first charge. It will always be a higher interest rate, but the good thing is you can extend the term for as long as you want. You can do it interest only. You can do it repayment. So there's lots of options. What would happen if you defaulted on that mortgage and you couldn't pay? They would sell the property, but the first charge lender would always get their money back first. And then if there is still money in that property and the property hasn't gone down in value, the second charge lender would then get their money back. And that's why they have a higher interest rate, because it's a slightly higher risk for them.
Yeah. Okay, that's good to have in your arsenal if you need to use it.
It really is. I really like second charges, and a lot of people in the UK are using them now because they've got really good interest rates, because obviously the interest rates in the UK are very low at the moment, and they've gone and got a really good product. But unfortunately, they've got themselves into a bit of debt, and they want to get rid of the debt because all the loans and the credit cards are costing them maybe £1,000 a month, whereas if we do a second charge, it could take that down to £100 a month. So a lot of people now are saying, look, I want to stay with my first lender because the rate is brilliant, but let's just get rid of the debt with a second charge.
Yeah. So could you explain portfolio loan and how does that work?
Portfolio lending.
Yeah.
Portfolio loans. Okay. So there's how to explain a portfolio loan. So there's 2 meanings really to portfolio loans. So in the UK, if you have more than 4 properties, you're classed as a portfolio landlord. And that has its own number of different things that can go against you. But the good thing is, if it's in a limited company, it doesn't affect you as much. But basically, once you own over 4 properties in the UK, all the lenders class you as a professional landlord. And what they'll do is they'll stress your portfolio differently and higher, which sometimes means that you can't always borrow as much. But again, it doesn't affect people so much when they're doing this in limited companies. Now, a portfolio loan, again, this could be a really good benefit. So in the UK, a lot of my professional landlords have 5, 10, 15, 20, 100 properties. Now, that can be really hard to manage because every 2 years, 5 years, you have to find a new mortgage product. Because in the UK, you fix for so long 2 or 5 years on a rate, and then when that rate runs out, you then go onto the lender's standard variable rate. So you need to switch to make it cheaper. So what a lot of my clients are doing now is they're doing a portfolio loan on their whole portfolio. So anything 20, 30, 50 properties, they're all giving them to one lender. And that one lender manages the whole portfolio as one mortgage. You can still take one of the properties out if you want to sell it. You can still borrow. You can still raise further money. It sometimes opens you up to more options, but you're then with that one lender with all of those properties.
Okay, because I always thought that before, I don't know if it was before the '08 crash, that you were not able to sell the one. Let's say if you have 10 properties and you want to sell 2, you were bound to sell all of them because they were all on one lender. But if it's like that, then it's very interesting as a investor to use portfolio like you mentioned now.
Yeah, definitely. And the good thing is a lot of the high street banks are doing portfolio lending now. I don't know how they would work with foreign investors. It's something I haven't ever done because I've never had a foreign investor want to do a portfolio loan. But as long as the loan to value stacks up, and the loan to value, let's say, is under 70%, as if the loan to value is across the whole portfolio is about 40-50%, as long as when you sell that one property, it doesn't make the loan to value go over a certain figure, it won't be no issue to remove that, and they will potentially recalculate the loan accordingly.
Yeah. Okay.
It's also a really good way. Just quickly, I had a client recently that we did that with. He had 14 properties, 7 of them were HMOs, and the rest were buy-to-lets. And what we did is we moved the whole portfolio to one lender. It did make the interest rate higher, but what we did is we raised lots of money and we took the properties up to 75%. And instead of them taking 14 of the properties on, they only took 7, and we repaid the mortgages fully on the other 7, which left them completely mortgage free. So it gave him a lot of options then, because he can sell them, he could then put mortgages back on them, but he had 7 properties that were completely paid off and only 7 still in finance.
Yeah. So would your advice be, let's say if you have a lot of properties, to maybe split it to 2 lenders because of the '08 crash, or you know what I mean, so they cannot possess the...
Yes, they can't repossess. It's a really tough shout, that. I mean, a lot of my clients have got their properties across different lenders, but I think to get to that situation, if you're looking at putting, say, 10 properties with one lender, personally, if they were my properties, I would look to go to that lender and pay off as many of them as I can. So I've got a big chunk of that portfolio completely mortgage free, but that's just how I would do it. And again, it's really important once you start getting to that level that you have a very good property accountant in the UK, because you need to be able to make sure that you're running the property in the correct way for tax benefits.
Yeah. Okay. And what about commercial lending?
Okay, so commercial lending basically means that you're purchasing a building for a business. So commercial lending could be that you're buying a block that has a kebab shop on the bottom and 3 flats above. Lenders will class that as commercial. I've got a lot of clients that own in London these big properties where there's like a Lloyd's Bank on the first floor, and they're in the London High Street, and they've got 3 flats above, and these properties are like worth 1.5 million.
Wow.
So they're classed as commercial because of the risk, because of the shop. And again, commercial finance can be used to buy businesses in the UK. So you might have a really successful garage and that's good with cars, and somebody wants to buy that as a business, so therefore you'd go commercial lending. Or you might want to buy my client in Dubai, what really interests him is he wants to buy a whole commercial outlet. So in that building, there's like 20 different shops all paying rent.
Mm-hmm.
So again, the commercial lending is used for that. The loan to values are a little bit stricter. You're probably looking at kind of like 35% deposit if you were going to do commercial lending.
Now we've come to HMO. What lending should HMO landlord apply for?
So HMO stands for a house of multiple occupancy. Now in the UK, the legislation's got very strict with HMOs. You need to make sure that the property is registered to be a HMO. I've had a couple of clients that have got criminal records because they were running properties as HMOs that weren't licensed to be HMOs. So again, do your reading on HMOs and what they should have. They should have their own license from the council to be a HMO. Each bedroom should have its own locks. There's loads of different bits and pieces. So just make sure if you're looking at HMO properties that I'd make sure you've got a good managing agent, because if you're not going to be in the country and you've got 6 different people living in one house, you need to make sure that somebody's managing it, because it can go wrong a lot quicker.
Yeah.
But with lenders, again, there are less lenders that do HMO simply because of the risk. A lender will lend you money on a property because of the risk factors. Now, obviously, if you're going to buy a buy-to-let, only one person, potentially 2 people are going to live in that property. If you buy a HMO, you could potentially be having students, new people coming every week. So the lenders, they're not such big fans on HMOs simply because it's a bigger risk. There's a bigger risk something could go wrong. But that being said, the profit potential on them is huge.
Okay. Yeah, so it's good and bad.
Yeah, if you're renting, like for instance, if you rented a 6-bedroom house out to a family, you might make £1,500 a month. If that property was a HMO, you could potentially be making £3,000-4,000 a month because you rent each room individually.
So could you explain development finance?
Okay, so development finance again is kind of, as it says, it's to develop, and again, development finance isn't the most straightforward. I have to say I haven't done lots of it. I do it, but it's quite complex and quite complicated sometimes. Most of the time, the lenders will want you to have the funds up front to start doing the first parts of the work. So they call it the footings, and the money will get released in stages. So it works a bit like bridging. It basically is bridging finance, development finance. The lender will give you 12 months, let's say, if you want 12 months or 18 months, and you could end up building, I don't know, a block of flats. So you buy the land, and then the lender will give you 100% of the funding to help you build that, and they will go up to a certain percentage of what let's say 65% of what that end game is going to look like. So let's give an example. Let's say it's going to cost you 500,000 to build, but when it's finished, the whole plot will be worth 1.2 million, and that would easily fit. But as I said, the lending will come in stages. So you'd buy the land, and then you'd make sure you had a proper development company that was going to help you, good builders, and then the work would get assessed at each stage. You would pay to have the valuations come. They would come out, they would assess the work, they would assess the standard. They would then say to the lender, yep, we're happy with that, and then they would release the next lot of money for you to do the next stage of the building.
Okay.
You can also do what's called refurb to let. So again, it's a bit like development finance. You can basically buy a completely rundown property and you do what's called refurb to let. So you refurbish it and then let it straight out. So there are those kind of loans available as well. But again, they're all kind of like bridging finance.
We as an international investor benefit if we get a credit card from the UK when we're applying for a mortgage, or is it only important that you have 2 years of record, of company record, and of books?
I think that's a tough question, because what what the lender's going to look for in the UK, they would really, really like for you to have a property in the UK, because it makes them feel more secure. But it's all about finding you on a credit file. Now, if you've never been in the UK and they did a credit search on your name, they're not going to find anything about you. So that's kind of a risk to them, because if you're in Sweden and you decide to not pay the mortgage, they're not going to be able to come out and find you, and then they're going to need to deal with the property. So the good thing about applying for credit cards is, again, it creates what's called a footprint on your name. You will have a credit file in your name. You will then have UK bank accounts and so on. So I wouldn't say it will be the be all and end all of you getting a property, but if you can get a UK credit card, then it can't hurt.
And what's your take on mortgage holiday, and how does it work? Is it good or bad to use it?
Well, it's another good question. Mortgage holidays at the moment, the lenders in the UK are allowing people to take mortgage holidays. Now, potentially, I've advised my clients to not take the holiday unless you really need it, because at the end of the day, you will still have to pay that interest and that money back to the lender. Now, whilst they're not letting you pay for 3 months, that's 3 months of, let's say, £700 that is going to roll up. And therefore, I know it's only 3 months, but it will just end up costing you more. So the whole aim is to not pay the lender as much money. So for me personally, I haven't taken mortgage holidays. But if it got to the point where I physically needed to and I started to get a bit worried about money, then I would then take a mortgage holiday. But they will. What will happen is, after you've had your 3 or 4 months holiday, they will recalculate the new loan and the interest you owe them, and then they will issue you a new figure and a new document.
And what's your take on business bounce back loan? Can we, as a international investor, apply for that as well, or is it just UK national?
So again, a business bounce back loan, unless you've got a company in the UK, it isn't aimed at limited companies for buy-to-lets. It's aimed at trading companies. And again, it would be, for instance, like builders in the UK that need money to get them out of trouble. So it wouldn't be aimed at investors.
No, okay. Yeah, just to get it clear, because there's been some talk about it in the property community. So how do you feel the market is reacting to the coronavirus? Are lenders getting back, or are they still frightened? I know you mentioned it before earlier in the podcast, but what's your take on it? What do you think will happen?
Do you know, I'm actually quietly surprised with the lenders, because it is such an extreme circumstance what's happened, and the lenders have tried their best to keep the market going. Now, at the moment in the UK, you can't physically go and value properties, so the housing market has practically stopped. But the lenders are doing everything that they can to try and keep the mortgage market moving. So, for instance, in the UK, normally you have to have a physical valuation. Somebody has to go out and check the property. But a lot of lenders now are doing remortgages, and even remortgages on new builds, and as long as the loan to value is under, like, I don't know, 90-80%, they're not visiting the properties, which I think is amazing. Interest rates are slowly starting to drop now. So we saw the England base rate drop. Everybody thought that the lenders were going to follow. I kind of didn't get that feeling, because at the end of the day, the lenders want to make money. And if they drop their rates too quickly, they're obviously not going to make as much money. So the lenders now are obviously getting their confidence back. So again, a couple of lenders today dropped rates. And like I mentioned in the beginning, when this first happened, a few of the specialist lenders, again, Gatehouse being one of them, they completely froze lending. They said, no, we're not taking on any new customers. I haven't seen Gatehouse come back. I haven't seen Octopus come back, but I have seen Shawbrook, Interbay and Precise come back into lending literally this week. So I think we've reacted well to it, and I do think that the lenders are going to want to do everything they can to get things going again as quickly as they can, so that they're going to basically need to offer investors and people purchasing property in the UK and remortgaging good reason to do so. So I think for the next 12 months is going to be personally a good time to buy, because property prices have dropped slightly, but also lenders are being more lenient with people.
Okay, yeah, that's a great take on it. So we have come to the end. This episode have been very information rich, and I think many of the listeners will appreciate what you have mentioned and taught them. So I'm gonna ask the same questions I always ask my guests. So what is your favorite book? 3 books?
Oh, favorite 3 books.
Yeah. It can be anything. It doesn't have to be money or life or property. It can be about, if you like science fiction or, I don't know, romance. It can be whatever.
So I love The Secret, the book The Secret. Mm-hmm. I love a book by Bob Proctor. I don't know if you guys know Bob Proctor. It's a kind of a law. He's the same guy in A Law of Attraction and The Secret. He's got a book that he highly recommended, and I've read it and I really like it. And it's called Think and Grow Rich by Napoleon Hill. Mm. Again, it's another great book. And then also I'm reading a book at the moment by Joe Dispenza, and it's called Breaking the Habit of Being Yourself.
Mm. Okay, that's good. 3 good books. And what about TV series or streaming series, if you look at any?
TV, I have to say I am a big fan of Netflix. And one of my favourite shows on Netflix, I have to say, was Sense8. I don't know if anybody in Sweden's seen that, but I thought it was brilliant.
Since I've seen, I haven't watched it, but I've seen it when you put on Netflix. Sense8. What it's about?
Yeah, what's it about? How do I say this without sounding completely crazy? So basically, it's about 8 people. Really simply, it's about 8 people from all over the world. So there's a guy from Africa, a guy from Germany. I think one of the girls was from Sweden, a lady from China, and they've all got their own unique special powers. And what they didn't realize is that somehow they were connected, and they had this special power. And at any one time, they could hop into the other person's body with their special power. And basically it was all about the governments trying to get rid of them because they were in fear of them, but they ended up winning. So that's a kind of short version of it.
Really science fiction. And what about movies then?
Gosh, movies. What could I say? I think one of my favorite old time classics here, and again, I haven't watched movies, but one of my favourites has to be Interview with a Vampire. So it's an old movie with Tom Cruise.
I think I've seen it, but I don't remember it.
That's one of my old movies. I'm trying to think of something that I've watched recently. Yeah, no, I can't think of any others. It's been a while. All I do is work.
That's good. So, if the listeners want to get in touch with you, how can they reach out to you? Do you have a website, Instagram, Facebook, LinkedIn? Yeah, what do you want to share? Maybe not your number.
I do have numerous ways of getting hold of me. My website at the moment is being reconstructed. It should be back up hopefully before the end of May. I think my email address is probably one of the easiest ways, and that is, I'll just spell it out. So it's Kate, which is Kate, and then it's at Gaia Financial, and Gaia is spelled GAIA financial.co.uk. I'm also on Facebook. Again, I've got my company on there, Gaia Financial, and my Facebook page is Kate Furzer, which is spelled Kate. and my surname Furzer. In fact, I think I'm down on Facebook as Kate Hunt at the moment because I'm in the process of having my surname changed just to confuse everybody. So if you're looking for me on Facebook, look for Kate Hunt, which is Hunt. But Gaia Financial is on Facebook, and then you have my email address as well. And on the Facebook page, and if I email you back, you'll have all my phone number details as well.
Yeah, I'll leave everything in the show notes.
What are your hobbies, just so I know?
Yeah, so my hobbies is, it used to be football, but it's not. I'm more into tennis now, playing it, not watching it. Being with my family, traveling,
I love travel.
Eating good food, that's and cocktails and rooftop bars. That's.
I best start coming to Sweden.
You're invited.
What's your favorite food then?
So my favorite food is. That was a good one. I have so many dishes, like pasta pesto is good. Yeah, I don't know.
That's
Fish,
okay. No, that's good. That's good. That's good. It's been such a good speaking to you, Nana. I really appreciate.
Likewise, and I hope that you enjoyed it, and I didn't take too much of your time.
Never. No. It's been really good. It's good. It's tested my knowledge a little bit.
Yeah, I think you will get bombarded by people who gonna ask you or reach out, because you're a great broker, and I'm looking forward to working with you.
Thank you, Nana. That's really kind.
So this was Pengaflöd podcasten. Nana signing out. Don't be stressed. Invest, people.
Absolutely. And take care, everybody.
Take care. Bye-bye.
Bye-bye, everyone.